name is Michael Guyett, publisher of the Lead Lag Report. I'm not a journalist. I'm not an anchor. Like David, I'm somebody with skin in the game, trying to help people get out of their echo chambers. Special guest for the hour is David Keller, chief market strategist at stockcharts.com. I use stockcharts.com religiously. If you're not familiar with it, you absolutely should be, which we'll talk about. But David, for those who are not familiar with who you are and your background, just introduce yourself to the audience as far as how you got involved in markets, what's your analytical skill set, and what do you do now?
Yeah, thanks so much, Michael. I've listened to your to the Spaces discussion before, so I'm excited to be part of this one today. I've been in the financial industry for about 22 years now. I'm now based in Redmond, Washington, just outside of Seattle. Joined Stock Charts about 3 years ago as their chief market strategist, and as you sort of alluded to, my goal there is to help empower individual investors and financial advisors to make better decisions. And it's challenging in some environments to encourage that, but that is where we find ourselves in. Before that, I spent about 8.5 years as a managing director of research at Fidelity Investments up in Boston. Before that, I learned technical analysis and behavioral finance in my early career at Bloomberg in New York. I came out of a liberal arts background studying music and psychology, so I knew absolutely nothing about anything related to the stock market. And I'll never forget when I accepted the job at Bloomberg, someone quizzed me on the stock market, and I think I got 0 out of 10 on the quiz. And it was basic functionality about the stock market. But the good news is a place like Bloomberg was willing to teach me and others coming from other backgrounds, what was what and what the Fed does and how to calculate bond yields, and getting to work with, a lot of different seasoned investors, and then getting to connect with technical analysts like John Bollinger and Tom DeMark and Connie Brown and others kind of early in my career sort of hooked me on this idea of analyzing investor sentiment through charting. And so, through the course of my career up at Fidelity, and then launching my own firm called Market Misbehavior about 6 years ago. And now with my work at Stock Charts, it's really trying to help people understand the markets, improve what I call their market awareness, which is just understanding what's happening around you as an investor. Because a lot of times you just get the blinders on and we focus on one particular trade or one particular idea. My goal is to kind of help people broaden out their perspective just a bit.
So I was smiling when you said music and psychology, and you said it had nothing to do with markets. I would completely disagree with that, and I'll tell you why I'm saying that. So, and I've made this point before, right? You know this more from formal perspective. I know this from as a musician myself, but there are always certain progressions that repeat in most popular songs. There's always certain chords that, when they're combined, tend to make for kind of a right environment to make a hit, right? And I kind of liken that a little bit to market repeatability, right? That there's certain things that you can kind of hear and see. And I remember somebody once told me that, I forget who it was, some musician once said that there was only one song ever written. Everybody's just got their antennas up, grabbing bits and pieces of it, right? Which we'll tie that into markets. And then on psychology, obviously psychology is a big part of market movement. Now, stockcharts.com is about charts. How do you blend psychology into charting when you try to help investors think through different ideas?
Yeah. And you're absolutely right. I've joked with my father now that, thank you for my college education, which somehow uniquely equipped me to understand the markets a lot better. And I think to your point, Michael, is I actually learned about Fibonacci numbers from music, because you studied certain composers that, the golden ratio came up because of how they composed. The musical scale is actually built on Fibonacci relationships and Fibonacci numbers. And if you don't know what I'm talking about, Google it, and you'll find all sorts of details about, the relationship between what sounds good and the mathematical relationships about them. But you're right. I think to your point, Michael, why does it make sense to look at charts? That plays on the psychology part of what I studied as an undergrad. And then when I learned that there was a set of tools that was literally designed to help you get inside the head of other investors and understand what they were thinking and how they were taking action based on their emotional state, I was completely hooked. And I would argue, while charts in some ways feel like a statistical analysis, and you and others have done really fantastic work in the some of your Dow Award papers, looking at utilities, looking at lumber. I've read all of the stuff that you did there. I think it was really well done. It was really a statistical analysis of what sort of patterns we can find out. What the fact that there's persistence to certain things, and we can make assumptions about what's happening and what that reflects in terms of the overall investment psychology. I would argue a lot of what I think of technical analysis, I think of it as three pieces. It starts with price. And Ralph Atkimpor and other early mentors of mine taught me that if you know nothing else about the markets, look at a chart of the S&P 500. That will tell you most of what you need to know about the current market environment. I think second to that is breadth, which is understanding all the companies that make up those markets. So right now you see breadth conditions really deteriorating. And it started with the growthy stuff, sort of the emerging growth, and then it got into other things. And now most things are sort of sort of acknowledging this bear market cycle. I think we're in the midst of, with some notable holdouts like energy and elsewhere. But then the third piece is sentiment, which is actually looking at survey data and looking at positioning, things like put call ratios and the VIX, which tell you the market conditions driven by how people are voting with their voices and how people are voting with their capital. And I think putting all of those together gives you a pretty compelling view of the market environment. I know for me, it's certainly indicated, toward the end of last year that things were starting to change. It's certainly indicated in the first quarter of this year that things are dramatically shifting. And if you watch the appropriate signs, looking at price and breadth and sentiment, while this year has not been easy, it's certainly been pretty straightforward in terms of the rotation to more of a distribution phase, which I would argue we're still in here.
So you said there's a persistency to certain things, but that persistency in terms of market movement, market dynamics doesn't necessarily mean consistency of returns, right? From an investor and trader standpoint.
No.
Talk about what it is you think that most people get into trouble with when they look at technical indicators, because I have to tell you, you mentioned the utilities paper, the lumber gold paper, and I'm kind of suffering through this. I've been very public about it this year in that my approach hasn't worked, right? This risk on, risk off, largely because treasuries have not acted risk off, except maybe now that's starting to change, right? Which we'll talk about also. But there seems to be this tendency, and I see it more and more, that people think if some indicator, whatever it would be, is not working in the here and now, they should completely abandon it. How do you get people to think differently about the times where a signal is not working so that they can actually benefit when it actually does?
Yeah. Two ways I would answer that. It's a really thoughtful question, Michael. Two things I would answer. First off, I think, I'm thinking of conversations I've had with Bob Prechter before. So he, sort of popularized Elliott wave theory and really, promoted. I'm not a huge Elliott wave fan, but I love the behavioral aspects. I think it describes, you read Prechter's writings and Frost's writings, who really, kind of came up with it, and Elliott, that, it really talks about the behavioral concepts, smart money versus dumb money, who tends to get in and who tends to get out at different phases in the market cycle. I think that's really, really helpful. But where my conversations with Bob have been really enlightening is we love to oversimplify. We love to think that, okay, the Fed is doing this, which means bonds should do this and banks should do this. The market's going up, which means gold should go down. Really simplistic relationships. And the reality is, if you tell me gold is a great safe haven, and if stocks go down, gold is going to go up, I will show you plenty of times in market history where that's been the case. And I will show you probably an equal number where that did not happen, where stocks and gold went up together or they went down together. And we love to simplify because in our human brains, that gives us comfort. It makes us feel like the markets are predictable. It gives us this illusion of control. Like we can, we have knowledge about what's going to happen next. In reality, the markets are a complex system. There are a lot of moving parts. And right now, name all the potential catalysts for what's going to move stocks on any given day. I mean, there's an endless list. There's the Fed, events in Ukraine, there's economic data, there's earnings, and how many hundreds others that can cause things to move. So if you find yourself making some simple call and then betting on that, I would say you're missing the fact that that is not happening in a vacuum. So I think that's one area where people get into trouble with technical analysis, where they get into assuming predictability that may not be there. The other part of it, I think, goes to what we would call, the robustness of a model or of an indicator. When you talk about something being robust, I never thought about this early in my career. I was working with a lot of hedge fund traders and a lot of trading floors in the Northeast, and it was all about just what could work today, what works in this minute, what tells me what's happening right now. But when I spent time at Fidelity with longer term investors, money managers who had really good long term careers, it was all about what's going to happen, what's going to work just today. but what's going to help me understand the markets over time? Like, what's my perceived edge over multiple years and multiple bull bear cycles? And that's where you get into robustness, right? If you find yourself coming up with this holy grail indicator, this one chart, and all you need to do is watch this signal and it makes sense, that's going to work until that time, then it doesn't, and then it's going to get completely worked out, because really specific approaches and indicators have a tendency to work for a limited period of time. My toolkit, you could argue, is very simplistic. I use a simple toolkit because I've always tried to use things that I would consider robust, meaning it's not going to work all the time, but it's going to work a lot of the time. It's going to work more than it doesn't. And it has to be something that I think has fairly consistent contribution to my analytical process. And things that don't, you have to get away from those. So, particularly with newer investors, I think their goal is to find that one thing that they need to watch. And if you do, just that's going to be great. Prepare for that to work for a limited period of time. And I think the best investors are the ones that understand that robustness check that they need to make on a model, which is why the best quantitative models are actually fairly simplistic. They're based on, for my experience, they're based on simple measures of price momentum that are probably going to work over time and through multiple cycles. But you have to be prepared for times like maybe this one where it doesn't work, and that's the challenge. That's why the game is not as easy as we'd probably like.
And it's important to note that everything will have drawdowns, maybe just at different times, right? And I think that's also what investors fail to realize when they try to follow an indicator or strategy. They think that if whatever they're following results in a drawdown, well, then it's not working, so go to something else. But by the same token, if some's, to your point, if something is a holy grail which doesn't exist, it's not going to have a drawdown. That's your surest way to fail, right? Now that
No,
leads to a
yeah.
discussion a little bit around again consistency, and you kind of alluded to this year. I keep making this point that every strategy consists of three components, right? Whatever signal you're looking at that you're back testing, whatever look back period on the signal, 200-day moving average, 50-day moving average, and then what's in some ways I think equally as important as the signal and look back period is the opportunity set, how you execute and what you're executing on. Talk about when you look at different asset classes, are there certain asset classes which lend themselves to technical analysis more than others? I know a classic technician would say, well, it's price, it doesn't matter, it works everywhere. But I want to hear your thoughts on that, because I think it's a lot more nuanced than that discussion.
Yeah, no, totally fair. And I think your 3 points, looking at the signal, the look back, looking at the opportunity set, I think that's a brilliant way of thinking of those three components for sure. To your specific question of about where technical analysis can be more or less valuable, absolutely. In general, I was taught by Charlie Kirkpatrick. I took over his course at Brandeis University. He wrote sort of the book called Technical Analysis, which was a college level textbook on technical analysis. And Charlie was big on, thinking about where technical analysis could be most valuable and what makes an environment where things should work. Well, number one, you have to have reliable data. And I think this is one thing I've run into, having traveled around, South America, developing Asia at times in my career. Markets that are less liquid, markets that are a little less developed, you certainly have trouble, because technical analysis is based on price data. And if you don't have clear data, transparent data, consistent data, it can be challenging. And I think you find that, certainly in US names with smaller stocks, right? With, like a pink sheet type of name, right? Over the counter stocks, where it's just not liquid enough, right? There's got to be a liquidity check. Because charts should reflect the behavior of investors. But if you don't have a clear lens because of the consistent data, I think it can be challenging. The second thing I would say is, yeah, I mean, the argument that I've heard certainly before is that price is price and it should work across all assets. Not necessarily, though, and I would say there are certain time frames, number one, where technical analysis can be more valuable. In the short term time frame, thinking about equities in particular, in the short term time frame, markets tend to mean revert, right? Meaning you're better off buying weakness and selling strength, because there tends to be that swing trading time frame, that sort of shorter term time frame where markets sort of over and undershoot where they should probably be at any given moment. In the medium term, if you're thinking out a couple months or so, you're better off trend following, right? This is where trends tend to emerge. This is where you're better off buying strength and selling weakness. If you're going longer out than that, I would argue technical analysis in terms of indicators, I don't know how much value that necessarily provides. I don't know if looking at a resistance level from 15 years ago is going to give me much of an edge today. But I would tell you that charting can be helpful because what charts do is one of my former analysts called it the truth serum for the markets. It tells you what has happened. It is the report card of how the markets have actually evolved. So I think charting can still be helpful. I think technical indicators and technical analysis, I don't see them as being that valuable. So I think the second check I would do is more of a time frame check and making sure that the technique you're using is in line with the time frame that you should be operating on. And then you just get into things like volatility. I mentioned Charlie Kirkpatrick was big on volatility.
I will say a lot of what David's hitting on is really critical, and I've done a lot of back tests. He mentioned the Dow award, which relates to the utilities paper, and the one on leverage for the long run. The other papers that you mentioned, as far as lumber and gold, won the Name Founders Award. And in all of my tests, a lot of these things I'm asking David are related to actually how do you create a robust back test that you can actually follow. David, can you hear me now? Yeah, no, you're right on the VIX, although that could still start to move. I had put out that tweet, I shared it in the space, that I don't think this can persist much longer. And I know that sounds really dramatic, but you can't have this kind of slow grind lower in equities when leverage and margins is high. So if this doesn't resolve itself sooner than later, I think the odds are actually pretty high of some kind of a major decline from these levels, which could be the capitulation everybody is looking for. And I'm not saying that just haphazardly. It's not a prediction, but even though it hasn't worked as of late, the reality is historically, when lumber's weak as it is now, when utilities are strong as it is now, when staples are strong, when treasuries are strong like it finally is now, all that tends to precede major tail events. More often than not, but we can talk about that. David, can you hear me now?
Yeah, can you hear me all right?
Yeah, perfect. So I don't know I forgot exactly where you left off there, but well, so let's kind of continue along some of the thinking, because I was kind of riffing a little bit on this idea that on the opportunity set, and Weisskopf's going to hit on volatility a second, that what's made this year so wildly frustrating is you really had nowhere to run except commodities, and most people are not investing in commodities. That's just the reality. Most people are 60-40. And traditionally, treasuries have historically been your risk-off asset. That wasn't the case up until last week, when suddenly it looked like treasuries started behaving inverse to equities when equities are becoming more volatile. Today, as we're speaking, is a good example of that. So I go back to the opportunity set question. The issue, I think, for a lot of traders, and correct me if I'm wrong on this, is that they fail to understand that everything tends to correlate to one more often than not, again, usually except treasuries. So they try to apply indicators on individual stocks, not keeping in mind the regime, which could affect the company specific story, right? So I want you to talk about how volatility factors into looking at charts for an individual stock when the broader market is acting more volatile.
Yeah, no, I love that question. And to be honest with you, I think with the opportunity set, I think that's a great point. You mentioned sort of the 60-40 split, and there's sort of a very traditional allocation process that particularly advisors have gone through, and a lot of individuals are still sort of thinking that way. And one of the beauties of what I think charts bring to the table, and if you look at energy and other things all mixed together, it becomes very clear early on what's working and what's not. And I think that's the main question a lot of investors should be asking is what's working, what's not, right? Where are the opportunities emerging? Where are the opportunities eroding? And I think charts very quickly will tell you what's happening. And I'm asked when something like energy or commodities just continue to strengthen, did I miss it? Did I miss it? Did I miss it? And I point back to the chart. Here's all the times you probably asked, did I miss it? And trends tend to persist, right? That's the whole point of momentum investing. That's the whole point of trend following, is that you identify trends and you follow those trends, and then you find some way to anticipate when the trends are exhausted. I think those are the three questions you should be asking as an investor. So find ways through some model, through charting, through whatever it is, to answer those questions consistently, and I think you're going to do overall pretty well. With the VIX, and you were talking about it a little bit earlier, Michael. I think what people very simplistically think of the VIX as being the inverse of the S&P 500, which in general has probably tended to happen, right? I mean, that makes sense that when people are kind of slowly accumulating shares, the volatility comes down because it's sort of like a slow grind higher. When people panic and start exiting positions aggressively, you don't panic and freak out and then very gently sort of lightly take some off the table. Like you panic and hit sell everything immediately. And that's why the markets kind of, take the stairs up and take the elevator down because of that sort of movement. But it's not 100% of the time, right? I mean, there will be times like we're seeing now where, I was reviewing a bunch of individual stocks this morning. I found 30 stocks in the US large mid universe that were making new 3-month highs today. I found over 200 that were making new lows. And if you go through that basket of stocks, it's just these nice, consistent downtrends in communication services and consumer discretionary and industrials and financials. And so it's sort of a relatively low volatility downtrend for a lot of those stocks. So it makes sense that the VIX is kind of coming off a little bit because things are kind of in that distribution phase and people are kind of unwinding positions over time, and the price is reflecting that. So having said that, though, I think overall, I tend to think of volatility in terms of volatility regimes. There's that period in 2019 where the VIX was pretty low, kind of in the low mid teens for most of the year. 2020 obviously spiked higher. The VIX went above 80 or so. Then it settled in to sort of that 20 to 40 range. Last year, it was sort of lower, sort of in the teens again. And now, once again, we're getting sort of a higher volatility range. So we're sort of in that 20, 30, even up to 40 range. And I think that's probably where we likely remain for a longer period of time. But you're right. I think the downtrends, and I think the argument for further downside is just these nice, consistent downtrends that aren't really showing signs of exhaustion yet from my toolkit. Yeah, I mean, I think volatility goes higher from here. I was asked early at the beginning of the year what's a prediction for the VIX, and my answer was it's going to spend more time above 20 than below 20, which at the time in early January it was still below there, and that was indicating sort of a different feel. I didn't realize the answer was it's not even going to get kind of below 20, which is what's actually played out. So from a technical perspective, you see this sort of lightening of volatility and then mid 2021 just consistently low as we were in that slow grind higher. I think as the markets roll over, this condition of the market going lower, there's still, I think for a lot of investors, they're in that disbelief phase. There's still, I mean, I still get people commenting about buying on the dips, which I get it as a short-term trade, but that is just not a great investment, approach in 2022. The more that doesn't work, the more people that are still looking to buy the dips and are underwater very quickly, that's what causes volatility to spike higher as people start dumping. So I mean, if you ask me to say is it higher or lower from here, I would most likely say higher. I don't see a scenario necessarily where lower would be a reasonable expectation. Looking at the chart and just based on what I was talking through there.
Well, and to your point about sentiment and buy the dip, I keep going back to this point that you need to get to a juncture where it's almost like PTSD, right? Where people are just like, I am not going to touch this damn thing ever again. And by the way,
Yes.
I still see that with the cryptocurrency space, with the way Terra, Luna. I mean, you had this complete utter crash, and then everyone's like, "Oh, I'm going to buy this. And it's going to go back up to $1." I mean, the insanity is just mind. I mean, and that's what makes me think that there has to be a lot more pain to come. But the sequence of returns and how that plays out is going to be critical, which we'll talk
Mm.
about. Can I don't mean to interrupt you, but that's really, really what you just said is really important in terms of how people are thinking about rising rates. Because if you keep on going at this rate on the long end, especially, how the hell is the U.S. government going to be able to finance anything?
That is a huge open question, and I appreciate it so much. A couple thoughts on it. Number one, I think what's so fascinating about how 2022 has played out is if you look at what the Fed had been doing and saying through the course of 2021 into the beginning of 2022, they so telegraphed what was most likely going to happen. I think they made it very clear, and again, they didn't say this, but we've been propping up asset prices. We need to change that. We need to address inflation, although they said it wasn't a problem. But all of the hints that they were making were pretty clear that that was what they were going to do. They're now executing that plan. So if you're surprised that risk assets are coming off, I think you missed some really clear signals about how much of 2021 and late 2020 was driven by a very accommodative Fed. And when you have a much less accommodative Fed, that can't just happen and risk assets continue to go up just as they have before. Things have to change. So I think that was one of those clear, looking back, it certainly seems like a very straightforward process that has been going on. So I don't think anyone should be necessarily surprised by the deterioration in stock prices so far this year. You're alluding to what their eventual plan is, and it reminds me a lot of what we would do at a larger money management firm when you're running a huge fund and you need to make changes in positioning. Your goal is to make a change to your portfolio, which would have the potential to really impact the underlying equities, right? Because you're trying to move, hundreds of millions of dollars of a position on a given at any given moment. And so we would basically try to make changes to the portfolio and have no impact on the markets and have no one understand what was actually happening, which the fact that we would think that that's something that's even possible is kind of laughable. And there are all sorts of tricks to try to do that using dark pools and breaking up trades and spreading them out and all of that. But at the end of the day, you're unloading a ton of supply into the market. And it's hard to imagine that happening without there being some deterioration in what you're trying to trade. And so I think it's funny that the Fed is trying to make these changes in policy, but somehow inspire people that they're still on top of everything and that they're way ahead of the game and everything's going to be fine. To your point, though, I think to be honest, yes, I think the goal is probably twofold. Number one is to bring asset prices down, bring risk assets down, addressing inflation and bring spending down, but at the same time not shock the market. And while the market has come down, it's really not. It's really been probably a fairly orderly decline relative to others. When things get really bad, and that's when people have talked about capitulation so far in 2022. I've seen downside capitulation. I haven't seen that yet. I've seen that. That's the puking out is what I usually describe as there's a puking out where you can't imagine. I think what you said, Mike, you could not imagine, buying things. Like there's just nothing that would inspire you to want to buy. The last, potential buyers like, forget it. This is just a horrible time to buy. And Walter Deemer, who ran the technical research team at Putnam Investments in the 1970s, his famous quote, "When it comes time to buy, you won't want to." So when you can't imagine buying stocks because they look so bad, that's when a bear market phase actually ends. And so that's the risk I think that the Fed is facing is creating that sort of environment where things capitulate too quickly. I don't see anything from a technical perspective that lines up with previous capitulation, sort of the end of the bull market or bear market phase. These are patterns that certainly look more as in a bear market is in full swing and there's further downtrend to be had. But you look for those signs of capitulation. It's not there yet. Yeah, good question. And I think it's just it's a there's always this question of like the systemic risks, right? What would be a collapse? What's the too big to fail type of thing where all of a sudden it creates a huge problem? Totally fair. Like there have been some major unwinds so far. There have been funds that have not survived this stretch very well. I think cryptocurrencies are a great illustration of the type of things that people assume are stable and are even labeled stable in some way, and they're not. It's an illusion of stability. um but again, it's sort of the open question is, has it been enough, right? When I'm talking about capitulation, it's less sort of an anecdotal evidence of a fund collapses and what does that do. I'm thinking more from a sentiment perspective. There are usually signs you can follow that show you when investors are just completely despondent, right? I mean, like there is no bullishness left in the world. No one's left to buy, and that's when things have actually come down. Breadth conditions get so negative, and if you look, what's happened right now is the markets have certainly come off. The emerging growth stuff, like Peloton type of names, have obviously come down quite a bit. The ARK Innovation names have obviously deteriorated. The FANG stocks now rolling over, but I'm still finding stocks that are in pretty decent uptrends, right? There are people that are still buying energy stocks and pushing those higher. I think the capitulation is when not even that sounds like you just want to get out of risk assets altogether. You want to go into fetal position and buy bonds and just try to survive. And that's what you've not seen. You've not seen that rotation, that severe negative sentiment, severe negative breath, which tells you pretty much everything's going down. And just to put a specific behind that, there's an indicator I follow looking at the percent of stocks above certain moving averages. So, what percent of the stocks in a particular universe are above their 50-day or above their 200-day moving average? And currently, and I'm not looking at it, but I think above the 200-day, it's probably about 25%, and the 50-day probably about 25, 30% ish, I would guess. In a real, completely bombed out market, those indicators both go to zero, where literally everything has broken down through moving averages. They're not holding support levels. And that shows you that there's an evaporation of buyers. And that's what we've not seen yet. So while the narratives have gone negative, while certainly the prospects, I think, of what the Fed is most likely going to continue to do, I think that weighs heavily on the equity markets. You're not seeing that bottoming pattern that has been similar to like 2008, 2009, or like 2001, 2002. We're not seeing that from a technical perspective yet. Well, I don't know if you're short, it's probably a big positive. But no, I think, and again, earnings this week, I think, has been super enlightening, right? And even in recent weeks, you've seen technology companies, and earnings can be a great potential catalyst. This is when, an Alphabet, a Meta platforms can come out, and all of a sudden the whole character of the market can change very quickly, where people start to see the green shoots. They start to see some signs of optimism. But what I'm seeing is more negative, particularly this week. Our Home Depot is kind of okay, but like Walmart, Target, now Costco, all rolling over and gapping down in a big way. A lot of the FANG stocks already did that big gap down earlier, right? So I think this has been a trend where companies are now acknowledging the headwinds that they're facing, which I again seem very clear if you open your eyes and look around. But I think companies now reflecting this is how we're going to have to adapt to this new reality. So yeah, but again, I think the market can handle it can handle Target gapping down 25, 30%, just like it handled Apple gapping lower, or Meta platforms or Netflix gapping lower. The market can absorb a lot of that because there are plenty of levers that people can pull. But again, it's just not it's not as broad of a decline, which seems funny because it feels like it is. But again, based on the indicators I'm mentioning, you're not seeing that broad decline similar to previous bear market cycles, particularly the end of the bear market cycle. That's where it's telling you it's not there yet. No, thanks so much for the questions, and I'm glad, good to virtually meet a Stock Chart subscriber. That's a pleasure. So you posed a couple questions. First, you alluded to sort of the rotation, and on Stock Charts we have what's called the relative rotation graph, which shows you a benchmark in the middle, and then all the assets that are sort of rotating around there. And I use it often for equity sectors. So you look at the 11 sectors and how they're rotating around, a U.S. benchmark. You can do it with global sectors and a global benchmark. You can do it with global assets, right, with different asset classes. And when you look at it, I mean, it's probably not a surprise, but pretty much anything related to the U.S. dollar and or commodities are playing particularly well over time, particularly on the longer term rotation, right? And that's been, I think, the story of 2022, is you have sort of the haves and the have-nots, and they've spread out. And so anything related to energy commodities, excluding some of the materials like gold, which have been struggling, commodity energy, obviously very, very strong. What else would I say? With non-U.S. markets, it's been tough, particularly for U.S.-based investors, just because of the strength of the dollar. I think that's also obviously been a challenge for gold, right? So if you told me before this year started that inflation was going to be acknowledged as a huge challenge and it was going to be maybe one of the key themes of the year, my immediate answer would be, then you buy gold, right? That's the way you ride that out. And it hasn't worked particularly well, right? It's had moments of spiking higher, but gold prices obviously have come down. A lot of the gold miners like Newmont and Rand Gold and others, which actually had just started to emerge, sort of failed and now have pulled back to longer term support levels. So that's not a really particularly good opportunity at the moment, and that's because of the strength in the U.S. dollar. So with the people I've been, with my own clients and others that I've been talking to, it's really been about the strength in the dollar. And until that dollar uptrend changes, there's not a great incentive for a US based investor to go outside of the US, generally speaking, just because of that. You're fighting a huge currency headwind to that sort of trade. At some point that changes, and then I think that that could be more compelling, but not at the moment. Your other questions, let's see. You had one about just thinking of longer term idea. Thinking about like weekly closes and monthly closes. One of my mentors, Jeff Weiss, who is a technical analyst at Jessup and Lamont for a number of years in New York, and now at Clearview Trading Advisors. He would always patiently wait for the weekly close and the monthly close, and he would draw these long term charts. And something would happen on a Wednesday, and I'd be like, Jeff, like, look at this is happening, this is going. He's like, this Wednesday means nothing. He's like, Wednesday's noise. Friday close, that tells me what happened from last Friday to this Friday. And sure enough, I would get all excited about this whipsaw sort of movement. He would just patiently wait for the next Friday and would acknowledge, okay, this is now happening. And he would, in general, be able to ride through periods of uncertainty much better than I would. So when I was creating my own market trend model, which I publish on Stock Charts, it's based on weekly data. It's using exponential moving averages, and it has three different time frames. And as of, I only update it every Friday after the close. Update the data and see, what the models are telling me. As of not this last Friday, the Friday before, all three of the models had finally turned negative. The short-term model has been negative for most of the year. The medium-term model turned a little bit positive, sort of in that March-April bounce, and then turned back negative. And that's my main sort of risk-off model, trying to tell me about the next month or two. So that's been negative for most of the year. And the long-term model just turned negative, 2 Fridays ago. And what that means is it very quickly now puts the S&P's current move in a very small number of observations, which would be sort of the major pullbacks in 2020, in 2018, sort of 2015 and 16, if you remember that sort of choppy pullback period. I think maybe 2011. And then obviously the big, distribution in 2008, 2009. And so it really confirmed to me, that we're in a severe distribution phase, and to be focusing more on, as much as possible, on managing risk and much less on finding opportunities at the moment. What shoes are left to drop? It's what I mentioned. When I look at this market, I'm still not struggling to find charts that actually look pretty good. And I think I will start talking about the market bottoming when things stop going higher. And it's particularly things like, any risk assets that I still see going to the upside. And screening for stocks today, it's charts that are actually working even as the market is struggling. So I think there certainly are more signals that could confirm even more of a negative trend than we've seen so far.
You mentioned energy, and I'm of the opinion also that this probably flushes out when energy itself starts correcting pretty hard, right?
Yeah.
And that's not a critique on the longer term thesis, but that's typically what you see also, that there really is nowhere left to run, and everything ends up selling off, including the prior winners, right? So, how do you think about the momentum in the energy sector here? And for those that maybe are a little bit late to the commodities game, would you say maybe it just makes sense to wait this out a little bit, or try to leg in on dips there? What are your thoughts
Mm.
on that specific sector?
Yeah, so no, really, really good points, and I totally agree with you. I mean, I think that's what you're still seeing certain things work, and energy materials have been part of that. Thinking of 2021 very simple, or 2022 oversimplistically, it starts with the emerging growth, the really growthy growth stuff. The ARK Innovation Fund type of things rolling over, but the FANG stocks still hold up. That's like one level of pullback. That's like the buy on the dips move, where the really high beta stuff is correcting, the small cap stuffs are coming down, but the real, the big tech names are going to be just fine. When Microsoft, when Apple are breaking support, which they both have, when the big, tech and FANG names are rolling over, that tells you that growth in general is not working. But then you have cyclicals, which are kind of working. And then I think that last piece would be, not, at this point, it's still people owning equities. It's just rotating to which lever within the equity space they want to own. When people can't even imagine that, because they're like, forget it, I just need to protect capital. You don't protect your capital by buying DVN or Oxy here. You protect it by getting really conservative and going to cash or T-bills or something like that. And that's that last move we really haven't seen. That's one of the certainly one of the things I would be looking for as a as an additional data point we haven't seen yet. Having said that, I mean, I've learned over my career to never be afraid to own good charts in any environment. That's a Peter Lynch trick. I mean, he would talk about, and obviously his method of investing is certainly it's probably, I mean, it was a beautiful process in the 1970s and 80s. The world has changed dramatically, so not all of it translates. But I love the idea of owning good companies and good stocks in any environment. And even in this environment, I'm finding stocks that are working. I'm finding charts that are holding up just fine. And so I'm never going to be afraid to own those. I wouldn't be afraid to own DVN or own Oxy. And I think just recently pulling back to the 50-day moving average, which both of those, MPC, all of those sort of energy names have kind of done now, rotating back and testing highs. I don't mind. I wouldn't mind taking a shot at those as long as you manage risk. And I think that's the key. I'm often asked, I have people that sheepishly through, stock charts or my own firm, market misbehavior, I'll have people kind of sheepishly tail between their legs came and say, all right, my position's down 30%. What should I do now? And my first answer is go back in time to when you first put the position on and set your stop there. Because, when I learned to fly airplanes, you were taught to have an emergency plan when everything's great, when you're flying straight and level, when everything's good, when there are no issues, you have no problems. That's when you're looking for a suitable place to land. That's when you're reviewing emergency procedures. So if something would happen, you don't have to figure out what to do. You kind of just go to the emergency plan. And I think for a lot of investors, they've been able to get away with not really doing that up until this year, right? You put on a position and just kind of let it go and then think about when you want to rotate out of that into something else or when to just leave it on. And the best place to develop your exit strategy is at the moment of entry, right? That's when you want to start it. So with something like DVN or Oxy or any of those names that are kind of working, PKDs and other ones sort of making a new swing high, I don't have a problem with it as long as you clearly define your risk, as long as you set a line in the sand and say when this hits, I'm going to reevaluate, and that limits your losses, allows you to participate in the upside if it would continue. Really, really good question. So I'll hit. You made a couple points that I'll try to address. First off with things like ARC, and I would, and this is, bear with me, but I would group things like if you're buying cannabis stocks here, it's certainly not based on trend following, and it's not based on the fact that the price action is telling you that there is any sign of optimism. It's basically it's a longer term play, and you're basically assuming that at some point the valuations are so attractive that this goes higher. Again, I've been trained as a trend follower, and I was taught price goes down for a reason. So if your investment case consists solely of it's gone down a lot, you're not doing it right, right? You're basing it on bad data. If the prices come down again a lot enough that I can justify the long-term play and accept some short-term pain to get there, that again, my time at places like Fidelity, they would be thrilled in this kind of environment because it's like, listen, I can get great companies at a bargain. I had to pay ridiculous multiples to get into some of these companies. Now I can buy, a fantastic company with great long-term prospects, and I can get it super cheap. I'm going to load up. The only way you can do that, though, is if you have cash ready to go. And that's why you need to be managing risk earlier on in this decline and recognizing the deterioration in ARC as much as possible so that you can, let leg in when you see the long-term opportunity. So in retirement account, I own cannabis ETFs, not because of the technical configuration, which I would still argue is pretty bad. It's because of the long-term growth prospects, pun intended, that I think that might present, right? And so I think that's one way to think of it. Think of it, do I have an opportunity to get into good stock, good companies at a discount? Can I make sure I manage the risk to that thesis? Absolutely. With something like Apple and even broader with the S&P, I think of it probabilistically, and I think, your question implies a certainty to the future path that I think we want to have, right? Does Apple go to 120 to 100 to 80? All of those things are certainly possible. Some of those are much more likely than others. So when I'm looking at the S&P 500, I would not just say, I think it's going to go to 3,800. I bet it bounces and I think it goes to 3,200, which you asked me to give a base case. That would probably be my base case here. That would make a lot of sense for a lot of reasons. However, there is a possibility that the bottom is in and that the S&P goes to 5,000 in the next 6 weeks. Is that likely? Of course not. But is it possible? Absolutely. Is it possible that the S&P goes down and blows through 3,200 on way to some much deeper level and retest the March 2020 lows? Yeah, that's a possibility too. Also improbable, but possible. So if you think about that really bullish scenario, that really bearish scenario, a mildly bullish scenario, a mildly bearish scenario, and then think about what that would mean to your portfolio, to your positioning, that is a really healthy exercise. So back in February, as the S&P is kind of coming off and it starts to bounce on my YouTube channel, I sort of posed this idea, these four possibilities. Here's the scenario where the S&P makes a new all-time high in the next 8 weeks. Here's the possibility where the S&P goes down and goes down to 3,800. And what would it look like? And in the end, we're sort of right between the mildly bearish and the very bearish scenario at the moment. That's kind of what actually played out. So I'm not surprised because I'd thought through that and thought, all right, what would that actually mean? Well, that would mean the risky stuff is going down and the FANG stocks would have to start going down as well, because if they hold up, there's no way the major indexes can go down to that level. And sure enough, they start breaking down, and that allows the major indexes, the S&P and the NASDAQ, to come down. So with something like Apple, with something like the S&P, I would be thinking about different potential outcomes and think about some probabilities as to how likely those scenarios are, what you would need to do to adapt to that environment. And then I think it's a much more healthy way of thinking about some of those scenarios. But my short answer is, yeah, I could see the S&P going to 3,800 en route to 3,200. If you think about capitulation, I would argue at that point, things would be capitulated to the point that you could make a great argument for buying stocks regardless at that level.
And David, where can people follow your analysis so they know exactly when to buy at those levels, or when it's going to those levels? How do people find some of your work?
But no, thanks. This was fun, you guys, and I really appreciate the thoughtful questions, Michael and others. Stockcharts.com, that's where I'm the chief market strategist. We have a lot of great research there from me, John Murphy, Martin Pring, Larry Williams, pretty knowledgeable guys. And then my website's Market Misbehavior, my YouTube channel, and everything kind of goes through there as well. So look forward to engaging with you there. And I'm on Twitter at DKellerCMT.
Perfect. Everybody that's here, hopefully you enjoyed the conversation. Everybody, make sure you follow David Keller. Check out stockcharts.com, obviously. And hopefully I will see you all later. I appreciate it. Thank you, David.
Cheers, Michael. Thanks, guys.